Welcome back to the Deep Dive.
Hey there.
Today, we're taking a close look at a recent earnings call. Some pretty interesting stuff came out of it.
Yeah, which one?
We're diving into the first quarter 2025 results conference call for Emerge Commerce.
Emerge, right.
Our goal, like always, is really to cut through the noise, pull out the important bits from that, call the results, the strategy talk, what management sees coming down the pipe.
Exactly. Get you the essential intelligence, basically. We've done the digging.
Okay, let's jump right in then. What did the Q1 numbers actually tell us? How did Emerge perform?
Well, looking at the headline figures, revenue was up 8% year over year.
Okay, 8%.
Reaching $5 million for the quarter. And the thing that really jumps out is this is now the fourth consecutive quarter they've had positive organic revenue growth.
4 quarters running. Wow. That definitely points to some kind of consistent trend, doesn't it?
It does.
But, revenue's one thing. How did that flow through to the bottom line? Profitability.
Right. And that's where Q1 showed a pretty significant turnaround. Adjusted EBITDA actually swung positive.
Oh, really?
Yeah, hit $32,000. Now compare that to the same time last year. They had a loss of $191,000.
Wow. Okay, so that's a positive swing of, $223,000 year over year?
Exactly. And management made a point of saying this is the first positive adjusted EBITDA quarter under their Emerge 2.0 strategy.
Getting into the black on adjusted EBITDA, even if it's $32K in Q1, which can be seasonally weak, that feels like a pretty critical milestone.
It does. It suggests that strategy, the Emerge 2.0, is really starting to bite on the cost side relative to revenue.
Makes sense. What about the net loss? Did that improve too?
It did, yeah. Net loss from continued operations narrowed. It was down to $20,000. Last year, same quarter, it was $82,000.
Better.
And they also mentioned gross merchandise sales, GMS, that's a non-GAAP number. The total value of stuff sold, it grew 8.3% to $8 million.
So momentum looking positive on several fronts there. And cash, how much cash did they have ending the quarter?
End of March 31st, they had $2.7 million cash on hand.
Right. So the big picture for Q1, continued organic growth, check. And hitting positive adjusted EBITDA under the new plan, check. Let's dig into the how. What did management say was driving this operationally, strategically?
Well, they pointed directly at the Emerge 2.0 strategy itself. They talked about creating a more streamlined company.
Right.
Direct management focus on that core portfolio, which is mainly grocery and golf these days. And this leaner structure, they explained, just needs fewer people, fewer resources at the head office level.
Okay, so efficiency gains from the new structure, that's part of it. What about growth? What specifically pushed that revenue number up organically?
Yeah, they highlighted 2 main engines really for Q1 growth. First was True Local.
The Canadian meat and seafood subscription box.
That's the one. Premium stuff. They said it's really benefiting from this whole support local movement happening in Canada.
Interesting.
Which apparently led to a big influx of new customers. And interestingly, they said the cost to acquire these customers was really attractive. Kind of like back in the peak pandemic days. Acquisition cost-wise.
That support local vibe is definitely strong. It's interesting how those external currents can just boom, bring in customers. What was the other driver?
The other one was their discount golf business. Brands like Underpar, just golf stop.
Right.
Management thinks this part of the business is actually getting stronger because the economy's weakening a bit.
Counter-cyclical, almost.
Kind of. The idea is people look for deals to get more price sensitive. And suppliers are more willing to use marketplaces like theirs to shift inventory when things slow down. So demand for discount golf goes up.
That's really interesting. So you've got one part riding the local wave and another riding the value wave in a tougher economy, both working for them.
Seems that way.
Now, we did see gross profit was slightly down year over year, just about 1%. Did they explain that little dip?
Yeah, they touched on that. Part of it, they said, was a larger than expected number of new True Local customers signing up with those limited time promo offers.
The intro deal.
Exactly, like the Buy Canadian intro offers. Those tend to have lower margins up front. And they also mentioned just some normal post-holiday refunds in January after a busy Q4.
Okay.
But importantly, they said they don't expect either of those things to really impact future results. It wasn't like a fundamental shift.
So temporary margin pressure from getting lots of new customers and just regular seasonal stuff, not a structural problem. Okay.
And we should probably remember Q1 is seasonally slower anyway, right?
Yeah.
Especially for golf up in Canada during winter.
Absolutely. Yeah, Q1 is typically the weakest spot for their Canadian golf side because well, it's winter. So hitting profitability improvements despite that seasonality makes the Q1 result, maybe a bit more notable.
Good point.
Oh, and they also mentioned they've already commissioned more cost savings work in Q1 and early Q2, things that should kick in and help profitability more through the rest of the year. Okay, so continued focus on trimming costs while pushing the growth levers. Now, Q1's done, but the call also talked about some pretty big stuff that happened after March 31st, right at the start of Q2.
Yeah, very significant developments. The biggest one was definitely the acquisition of T2 Green Limited, T2G.
T2G, okay.
That deal closed April 4th, 2025, so just after the quarter ended.
And T2G, what exactly do they do? What kind of business is it?
They described it as a profitable business focused on discount golf apparel and equipment. It's been around a long time, like 38 years.
Wow.
And really focused on the Canadian market.
A long track record. How were their financials looking recently?
Well, based on their 2024 numbers, which are unaudited, T2G did $6.4 million in revenue.
Okay.
Adjusted EBITDA was $1.3 million, and net income was around $700,000.
Whoa, hang on. $1.3 million in adjusted EBITDA. That's pretty substantial compared to the $32K Emerge just posted for Q1.
Exactly. It's a significant bump. And management talked a lot about synergies.
I bet. What kind of synergies?
Well, they see it fitting really nicely with their existing golf businesses, Underpar and just Golf Stop. Highly synergistic. Plus, Emerge already has this big database, 400,000 golf subscribers, they said.
Right.
They reckon they can use that database to scale up T2G's business way more cost effectively than T2G could do on its own. Cross-selling, marketing efficiencies, things like that.
That built-in audience, yeah, that sounds like a powerful way to integrate and grow T2G quickly. How did they pay for it? Did they have to issue shares or raise money?
No, and they made a real point of this. No capital raise was needed.
Nice.
They used cash they already had on hand from selling off other assets previously, specifically from selling Carnivore Club and also selling some shop domain names to Shopify.
Ah, okay. So using proceeds from prior divestitures to fund a strategic acquisition without dilution, that's usually well received. What else happened around that April 4th date? Anything else major?
Yes. Also on April 4th, they managed to end their existing credit facility, their loan agreement.
And what changed?
They got an 18-month extension on the maturity date from their current lender. Plus, there's an option for another 6 months on top of that, though that needs the lender's okay later.
So potentially pushing their main debt deadline out quite a bit further.
Potentially, yeah. If they get that extra option, it could go all the way out to April 2027.
Mm.
And they mentioned they're in good standing with this lender. They've been working with them since like late 2019.
Getting that extra runway on the debt facility certainly gives them more breathing room, more flexibility. Did they say anything about interest rates? With rates potentially coming down?
They did. Because the facility is variable rate, management said they expect that if or when the interest rates fall, it should lead to meaningful cash savings for the business.
Yeah.
Lower interest payments.
Right. Lower interest costs feeding straight into cash flow, another potential positive there. Okay, let's pivot then. Looking forward, what did management say about the outlook, especially for Q2, the quarter we're in now, and maybe the rest of 2025?
They sounded pretty upbeat about Q2. Said the trends they were seeing so far in the quarter were actually stronger than they'd expected.
Oh, really?
Across the board.
Across both True Local and the Gulf side, yeah. So for Q2, the forecast is for accelerated double-digit revenue growth.
Accelerated double-digit growth. Okay, that's a step up from Q1's 8%.
And strong positive adjusted EBITDA for Q2 as well.
Strong positive. So better than the $32K in Q1. What's driving that expected acceleration in Q2?
Well, basically the same drivers as Q1, but just with more, True Local is expected to keep riding that Buy Canadian wave.
Right.
Remember, they already reported operationally mid-Q1 that net new subscriptions were up like 193%. So that momentum seems to be carrying through.
Yeah, that's huge.
And the discount golf side, again, benefiting from the macro climate, the recession-friendly aspect. Plus, now we're fully into the main golf season, so seasonality turns positive for that part.
Makes sense. And the huge difference in Q2, of course, is T2G results will be included for the first time. Exactly. That's the big kicker for the Q2 outlook. It's the first quarter that will reflect T2G's contribution. Management expects that to substantially enhance the company's overall revenue, profitability, and cash flow profile, starting right now in Q2.
Right.
And they also think that stronger financial picture could help improve the balance sheet and maybe even lower their cost of capital down the road.
So bolting on T2G with its proven profit track record is really expected to move the needle significantly starting this quarter. Did they lay out their main priorities for the rest of 2025?
They did, pretty clearly. Three main things. One, accelerate revenue growth. Keep that momentum going.
Okay.
Two, keep finding more operational efficiencies and synergies to drive profitability even higher.
Right, the cost side.
And three, opportunistically look for ways to boost cash flow and cut interest expenses.
Got it. Accelerate growth, boost profit through efficiency, enhance cash flow. Those line up perfectly with the Q1 results and the T2G deal and the debt extension.
Okay, let's bring it back to you, the listener. Why does all this matter? What's the sort of so what here? Well, the core message I think that management wanted to get across is that they really believe their strategy, Emerge 2.0, and the businesses they have now, they think they're exceptionally well positioned. Not just to survive the current tough economic climate that's hitting a lot of companies, but maybe even to benefit from it.
How so? Positioned how?
Well, they see these specific opportunities, right? True local, potentially becoming like a really visible brand for that support local movement in Canada. And the discount golf business, they argue, just keeps getting stronger as the economy softens and people hunt for value.
So they feel like they've got businesses that are resilient, maybe even counter-cyclical for times like these.
That seems to be the story they're telling. They framed these Q1 results, the T2G deal. It was all presented as management continuing to deliver on key priorities with precision.
Right.
And the big thing they're pointing to next is that expected supercharge, their word, kind of growth and profit, once T2G fully kicks in starting Q2. Execution seems key.
Yeah, it definitely sounds like a period of intense focus on execution and putting the pieces together. So just to recap, we heard about continued organic growth, that important first positive adjusted EBITDA quarter under the new strategy, the big T2G acquisition funded smartly, the debt extension giving them flexibility, potential help from lower interest rates, and a pretty positive accelerated outlook for Q2 and beyond.
Yeah, quite a lot happening. Feels like they believe the major strategic moves are now in place.
Indeed. Okay, here's a final thought maybe to chew on as you think about Emerge Commerce. Management's clearly leaning into the idea that true local benefits from support local and discount golf benefits from a weaker economy. Specific tailwinds, right?
Right.
So how sustainable are those specific trends? And what happens if the macro picture shifts significantly? Like, what if the economy suddenly strengthens or that support local feeling fades a bit? Is the Emerge 2.0 strategy and the portfolio they have now resilient enough to keep thriving even if those particular tailwinds change direction? Something to consider as you watch them navigate the rest of 2025.